right. We're going to get this thing kicked off. Hopefully everybody's enjoying your lunch. Please continue to eat. I just want to say thank you so much to all of you for being here. Thank you to our sponsors. Thank you to our exhibitors. We have a great day lined up for you, starting with the power lunch, and then right next door at 2 p.m., we will get the opportunity to hear from and meet our new university president, so stick around for that. And then the show floor opens at 3. So we have a great day lined up, starting out with this great panel. This is our 3rd year doing this power lunch with the Carson College. Thank you so much for that partnership. And without further ado, I'm going to introduce the Dean of the Carson College, Debbie Campo.
Thank you very much, Tony. Can I get a go Cougs, please? There, thank you, we needed that. So as Tony said, I'm Debbie Campo. I have the honor to be the Phyllis J. Campbell Endowed Dean of the Carson College of Business. I became officially the Dean on January 1st, and I am so pleased that our deanship now carries the name of an alumnus with the stature of Phyllis Campbell, so that's really awesome. I'm also really pleased we formalized our partnership with CougsFirst over this last year. And so 3 of us from the university have joined the CougsFirst board as ex officio members. And I think that's a really, really important partnership because the College of Business at Washington State University needs to serve the business community as a whole. And CougsFirst is a great place for us to partner with CougsFirst, to be around Coug Business alumni, whether they are alumni of the College of Business or not. You're all really, really important to us. One of my critical goals as the Dean of the College is to increase our visibility across the state, and really especially within the Seattle region. I think it's really important for the Dean of the Business School that graduates the most business graduates of any university in the state to be part of the business community. Absolutely. So I'm making a real effort to be here in Seattle and in the region as much as I can, to be at events where we can visit with our alumni, where we can hear from our alumni, and be seen as part of the business community. We want to be creating pathways for our students into jobs in the business community. We want to be hearing from you about your needs for those graduates, and we want to be sharing our thought leadership with you. And so Power Lunch is, to me, a great opportunity for us to share an area that we care a lot about. Our Center for Entrepreneurship is one of 5 centers in the college, and it's a really important center for us. And so this panel today really showcases our investment in entrepreneurship and our interest in supporting entrepreneurs in the state of Washington. So with that, I'd love to welcome the panel up on stage. And I'll let them get in and get settled. And I am very pleased to turn the discussion over to Marie Mays. Marie is a scholarly associate professor in the Carson College of Business and academic director of our Center for Entrepreneurship, having served as director for as many years as I've been at Washington State University. So I'm going to turn it over to Marie to introduce the panel and the panelists. Thanks, Marie.
All right, thank you, Debbie. We're thrilled to have you here, so good afternoon, everyone, and welcome to our panel on navigating funding options for your venture. We're thrilled to have an outstanding group of panelists joining us, each from a unique perspective in funding, and they come from different landscapes of the funding business. And so here's our agenda for today. I wouldn't be a professor if I wasn't going to give you an agenda, right? So I'm going to just briefly introduce introduce them, and then they'll have 5 minutes to give some opening remarks, and then we'll have some focused question time, and then there'll be some Q&A time from the audience. So this will be your opportunity to ask some questions directly from our panelists, so be thinking about those questions now. Okay, so I'm going to go ahead and just briefly give you their name and the organization they're from, and then I'll hand it over to them. So we have Jody Page from PACAM, a consulting and advisory firm, and Jody has extensive experience in debt financing. And then we have Pat Murphy. Pat is from Lead Scores, and Pat's going to bring the valuable lens of an entrepreneur who has successfully raised capital. So Pat's also an angel investor, so we can tap into that as well, but we really wanted to have someone who had raised capital and have that perspective on our panel today. Also next we have Daniel Hatch from BECU, and he's representing the banking perspective and the important role that financial institutions play in supporting small and growing businesses. And finally, we have Austin Guyette, and Austin's from Voyager Capital. We're happy to have him. Voyager Capital is a venture capital firm that invests in early stage tech companies across the Pacific Northwest. So with that, I'm going to get them started. I'm going to hand it off to Jody, and he has his own mic, so he's going to give us his 5 minutes of opening, and then we'll just move down the table after that.
Sounds good. Good afternoon, everybody. Again, name is Jody Page. To Marie's comment, I have a pretty extensive background in financing early stage, primarily software as a service businesses, B2B, business to business. I've lost count. Probably 150 different financings ranging from like 50,000 to maybe 10 million at the high end. Interestingly enough, the firm that I did a lot of those transactions with was called is called Lighter Capital, and Voyager is actually an investor, and actually Lighter Capital was incubated inside Voyager Capital, just to give you a sense of how small this ecosystem is. Over the course of last year, after a long run at Lighter, I took a little bit of time off, 9 months. I'd never done that before in my post-college life. That was a bit of an emotional roller coaster, actually, and ultimately started the PACAM, which is Page Advisory Consulting and Asset Management. And so I still do debt raising advisory work. That's a very transactional business, so I also do some fractional consulting, management consulting, some FP&A, financial planning and analysis work, and recently took on a partner to expand our offerings to include marketing services as well. So that's a little background on me. I don't think I need to take any more time than that.
Maybe if you would also just share just really quickly a little bit about debt financing.
Yeah. Did I just turn it off? Hello? Okay, there we go. So the debt landscape is vast, very vast, right? And I kind of bucket it in two buckets. There's banks, and then there's everything else. And banks, generally speaking, are relatively constrained in how and where they can lend money. And that's where the private debt landscape, which is where my expertise and background becomes relevant, because it's a very large, fragmented ecosystem. It is probably the fastest growing asset class in the private capital space, relative to private equity and venture capital. And there's a lot of different flavors of it. And the way that I like to describe it is that as my dad used to say, all money ain't good money, right? And just because somebody's offering you money doesn't necessarily mean it fits with what you're trying to do as a business. And when I say fit, there's kind of two key things to me. There's does it align with your kind of the mechanics of your business, as I like to call it, kind of how you move as an operation? Does the money align that? And then most people looking for outside money, be it equity or debt, there's a strategy they're looking to employ, hopefully, as opposed to just trying to survive. And does the money align with what you're looking to do strategically? And that is really where the private debt landscape, as an alternative to selling equity in your business, is important, because it's actually a pretty small cut of businesses that actually are capable of raising venture capital or private equity. And if you can't go to a bank, then you might find yourself in the private debt landscape, which is great for me because it's not like there's old school reference, not like there's a phone book of private capital or your debt providers. You need somebody that understands the landscape and the nuances of these debt instruments to make sure that you don't get yourself into trouble by taking the wrong kind of capital at the wrong time. So that is effectively kind of how the private debt landscape works.
Great, thank you. All right, we're going to pass it off to Pat.
This on? Yes. Good afternoon, everyone. So my story with fundraising started, my first exposure was my very first job out of graduate school at WSU when an angel investor named Newton Clark, who was a friend of Ron Markin, who was the dean at the time, introduced me to an entrepreneur named Bill Carell. And Bill was a former clinic manager that was running a software company that computerized HCFA 1500 insurance forms on TRS-80 computers that had dual 56K 8-inch floppy drives. And you put the program in one drive and the data in the other. And so they convinced me during a round of golf to go to work, put my MBA to work for a software startup working on commission, selling these systems to doctors, their very first computer system. The lesson I learned was that when you're doing entrepreneurial type ventures, inherently, no one really knows how to do it because you're usually doing something new and something disruptive, applying new technology. My whole career has been in software generally and business applications. And so the second year into that job, which I was doing great, I was selling these things like hotcakes, literally. Newton Clark and Jim Huber, who was on the board at the time, came in and fired Bill and shut the company down because we were burning cash way faster than they were able to support it. So that taught me a very important lesson to your point about knowing what kind of money you're taking. I took a hiatus from fundraising world until 1997 when I joined N2H2, and subsequently we took that company public in 1999. In the interim, took angel money, took VC money, took bridge rounds, and finally did a successful IPO, which was experience and education on many levels. And it had a very good outcome because it allowed me to do what I've been doing for the past 20 years, and that is building other businesses and helping other businesses grow as an angel investor and advisor and so forth. Looking at the fundraising arena from the entrepreneur's perspective, I mean, there's so many things that I could share based on experience. Since 1999 to the day, I don't think there's been a time when I haven't been raising money of one kind or another. My current venture, Elite Scores, Inc., raised initial funding from a Microsoft venture that we spun off, and then raised some angel money, and then raised some additional angel money, and then finally did a Series A 2 years ago with a corporate venture partner that was a customer. So the lessons to be learned, and it can be applied for any new entrepreneur that's trying to get a venture started. I mean, my primary advice is ask for a lot of advice because I didn't know what I was doing most of the time, and you had to learn by trial and error. There's so many different types of money. If you have a good idea, there's usually someone that will fund it if you can present the opportunity correctly to them, and if it fits with your business plan and fits with their funding plan, their investment plan. I got involved with Keiretsu. Many of you probably know Keiretsu Forum, Nate and Brianna McDonald, which is a local angel group or a national angel group, local chapter. And after investing on my own in some early stage companies kind of blindly and had a few hits and misses, but I joined an angel group. And that's another form of angel funding, a more organized system for raising angel capital that I think is worth considering for most entrepreneurs. It's just one source. So that's pretty much the highs and lows of my background. I think we'll get into more details as we move forward. Thank you.
Great, thanks, Pat. Okay, we're going to hand it off to Daniel to talk about BCU.
All right, BCU. Okay, first of all, I have to apologize. I'm wearing purple, and I didn't even think about it, okay? I have 3 young kids that were screaming at me this morning. I had a red shirt picked out, so just blank it out. Someone help me with CGI or something like that. So, BCU is a credit union, so a little bit different than a bank because we're member-owned. We're not publicly traded. BCU is celebrating its 90th year. We started in 1935 with 18 members of the Boeing employee group that were just kind of funded money together and then started making loans to other mechanics in order to buy tools. So today we have 1.5 million members across Washington State, Idaho, Oregon, Arizona, a little bit in Texas and South Carolina. Of those 1.5 million members, we have about 85,000 business members as well. About $29 billion in assets, $20 billion in loans. And then in my group, I'm director of commercial lending for all of BCU. So we make loans to businesses, which includes investor commercial real estate, owner-occupied commercial real estate, lines of credit, credit card, equipment loans, stuff like that. It's about $3.4 billion in loans we have out to our community. I've been doing commercial lending for about, I almost knocked that over, for about 17 years. I've been at multinationals, WAMU, Bank of America, to some regionals, what's now Umpqua, as well as a few community banks. And I've been with BCU now leading this team for about 3 years. So far as funding goes, I mean, I think what Jody was saying, just because you can get debt or funding or whatever is available to you doesn't mean that it's the right thing for you at that point in time. And I think there are partnerships, there are times when banks need to come in, and the constrained is a perfect word for it because we are highly regulated. And so initial startups are very difficult for a bank or credit union to deploy capital right out of the gate. So one of the first things that I say, especially when there's startups that are coming in or whether you haven't had really 3 years in business, is capital does not replace capital. So you have to have a capital stack, whether that's through a capital partner or friends and family or whatever it is, and then move onto the debt component of it. And that's really where traditional banks and credit unions start to come in. There are avenues, and hopefully we'll have some questions and answers about this a little bit later, through government-sponsored programs, specifically the SBA, the USDA also has some that can really help out. But again, the capital component is a really big one because those restrictions that come along with that type of a debt can hinder your growth, or they can put some constraints on exactly how you operate. So I think that's kind of it for me.
Okay, awesome. We're going to hand it off to Austin.
Yeah, sure. Hi, everybody. Thanks for being here. My name is Austin Guyette. I'm a partner with Voyager Capital based here in Seattle. Voyager is a venture capital firm that's been around since 1997 here in the region. What we do is we fund an equity component of early stage technology companies. Voyager is primarily B2B focused. The industry funds a whole lot of different things, from consumer to life sciences to stuff that maybe doesn't really have a category. If you think about what we do as venture capitalists, right? We raise money from institutional investors, think endowments, pension funds, nonprofit foundations, and we take that money and we take minority equity stakes in early stage companies, hopefully ones that become very, very big companies someday. And venture capital is a really weird asset class, right? And it's weird because nothing you learn in traditional finance class really applies to what we do, right? So you're in business school, the first thing you learn about, hey, how do I value this asset? Well, discount the cash flows. Our companies don't have those. Well, okay. Well, maybe you can take like a value to book or something like that. No book value in these companies either, right? And this is an asset class that exists because not a whole lot of entities want to finance that type of thing, right? And if you look at like conventional equity investing, let's take something like the public markets as an example, right? You have outcomes that follow a bell curve, and most of the outcomes are somewhere in the middle of that bell curve. For the most part, the stock market goes up by a couple percent, it goes down by a couple percent, and pretty famously, public market investors ignore the tail events, right? The finance press loves to talk about crashes and big upswings in the market, but those are pretty rare, right? In venture capital, all I care about are tail events, the big ups and the big downs. In a portfolio of 10 companies, I'll make 10 to 100 times my money on one company, and I'll lose all my money on the rest, right? That's living in the tails. And so if you think about what investing is, right, it's really educated bets on an uncertain future, and depending on where you're investing, that level of uncertainty can be small, maybe a little bit bigger. Venture capital just takes that risk and turns it up to 11, and that's sort of what we do professionally.
Great. Okay, thanks to all of them for giving you just a little overview of what they do and the aspect of the funding markets that they're involved in. So I'm going to ask a couple of focus questions as a follow-up, and I think one of them that's important is to talk a little bit about misconceptions with their particular funding type. And so I'm going to throw it back to Austin a little bit, because I think there's so many misconceptions about raising venture capital funding. And so I'd love for you to talk a little bit about that, about what are some of the misconceptions about accessing that particular variety of capital. That'd be great.
Yeah, sure. So you can think about all of us as providing different types of fuel for companies. And if you're running a business, you should think very critically about the fuel that business needs. What venture capital is good for, right, are, you can think about it as like technology finance, really. Companies that need a bunch of upfront investment to build a piece of technology, that when it's built, the marginal costs of distributing the next thing are orders of magnitude less than what it took to build that. Famously, venture capital started with semiconductors, right? It takes a bunch of money to build a semiconductor company, but each one of those chips, making one once they're created, doesn't really cost that much, right? Software is another thing that venture capital is very good for. Building a software application takes a bunch of time and money, but there's no marginal cost of distribution for that thing. The other thing venture capital needs are very, very large, often binary outcomes, right? Either this company is going to work and be publicly traded on the NASDAQ or New York Stock Exchange, or it's going to be worth nothing, right? Again, I need to make 10 to 100x my money on one company, lose my money on the rest, and come out positive, right? That only works if those big outcomes, when they happen, are really, really large. Conversely, like, hey, you're maybe doing like a restaurant chain or something that can be more deliberate in how those cash flow or roll out. Venture capital is very expensive money, right? Like I invest a little bit, I take a fairly significant equity owner stake in a company. There are cheaper options to that as you look down the line here. And you should optimize for, hey, what is the cheapest capital that I can get that matches what the outcome, right, for my business is likely to be.
Yeah, that's great advice. Thank you. We'll throw it back to Daniel as well, just to talk a little bit about your space. And you and I were talking earlier a little bit about both how you would prepare to raise bank funds. What are you looking for? You made some mention to it earlier a little bit. What are you looking for in someone's financials in terms of what you do? Sure.
I think just touching quickly on like the misconceptions for accessing not capital in this case, but in debt. The really thing about banking is, which is kind of a conundrum, is if you need debt, you're not going to get it. So it's a really good idea. You want to start early, and you want to start smart, and typically you want to start small. And that goes on both sides. It was just kind of what she's alluding to quickly is first and foremost is you have to have your personal house in order, right? So when you're starting out a business, really what you've got is you've got personal credit. And banks, for the most part, business credit scores don't really exist. There are a few of them out there. It's not widely used and it's not widely accurate. So what we do have is FICO scores, and what we look for when you're starting out a business, maybe you're 1 year into, maybe 2, 5 years, whatever it is, and you're coming for a credit card, you're coming for a small line of credit. We're going to be looking at your personal FICO score in order to see can you manage your own personal finances? Can you pay consistently? And so having a strong FICO score, having a strong balance sheet on your personal side is a great demonstration of what you can tackle when you're starting up a business. So that's the first and foremost. Also, developing partnerships, any type of partnership here is a really big deal. And that's why, I would lean when you're talking about smaller businesses or the startup side of it is finding a personal connection, and you find that personal connection through even just opening up a depository account, going in, shop local for the most part, shop a little bit smaller if you can, because you're going to have some ups and downs, you're going to have some questions, you're going to have some financial health learning opportunities that are out there, and a lot of the more community financial institutions are going to be able to provide that for you. So that's the really important thing, is focus on your personal first. Get something started, get a depository account, meet that banker if you can, maybe open up a credit card or a small line of credit under a scored system, which again we'll be looking at your FICO score, and just kind of build up that rapport. I am not saying go out and fund your startup with a credit card on a scored business or anything like that. That's not what I'm doing. But just like when you're getting out of college or something like that, having that credit card, paying it off every single month, that will develop pay history, and you can use that pay history to kind of cash in for larger loans in the future.
Great, thanks for addressing that. One thing also, and you can both speak to this a little bit, but I think there are a lot of misconceptions about angel investing, and how do you connect with angels? How do you do that? How did you initially get to know those folks when you raised that capital, and how do people reach out to you as an angel investor when you've made your angel investments? Yeah, for you, Pat.
Sure. Well, first question I'd ask is, why do they call them angels? Because most of the angel investors I worked with, they're nice people, but they're not in it, for any philanthropic reason or spiritual reason. They're in it to make money. And perhaps it has something to do with the typical entrepreneur's due diligence process, which is pretty much counting on a hope and a prayer that the entrepreneur knows what they're doing and can actually build a business around the idea that they came up with. But I think that one of the most common misconceptions from the prospect of the entrepreneur looking to fund their business at the very outset is that the investors they're going to attract are going to be attracted and willing to invest in them because they believe that they believe they can calculate an eventual return on their investment. And that's simply not the case. Pretty much every entrepreneurial presentation that I've seen for seed money or even Series A money generally has the hockey stick revenue ramp, after a year or two. That's very rarely the case, and the focus for angel investors is on what is the next milestone that my money can help you achieve in building your product or your service, number one. And yes, there has to be an addressable market that is sizable enough to, offer an opportunity for some serious growth, because you ultimately need, to sell a lot of whatever you're doing to make a return for your investors. But the most important thing is looking at the entrepreneur themselves and the team, and whether that founder is someone that you have confidence in, can put together the team and build a business around this idea. And it comes down to personality, but not necessarily the personality that you would think. There's a reason that a lot of many early stage companies, the entrepreneur, once they get to a certain point in their growth and development, needs to bring in someone else to run the company. I speak for myself. There have been points where I've been involved in launching a company with partners or by myself, and ultimately, there's a point when I know my best role in that company is not as CEO, or at least there's a need to bring a management team in around me. I guess the other myth about angel funding is that it's just a numbers game. Nothing could be further from the truth, and I've seen this a lot. Entrepreneurs think, if I just get enough meetings, how many times have you heard this? If I just get enough meetings, eventually somebody's going to say yes. It doesn't work that way. It's about finding the right alignment of values, the right alignment of investment strategy, and alignment of how that entrepreneur, in my case, can help the business grow, not just with my money. My personal investment criteria, it focuses around, either I know the founding team and I really believe in the type of product. Most of my angel investments have been in med tech devices, where I really know nothing about building med tech devices, but I recognize talent and I recognize how well businesses are organized and what their general potential is. So I will make a bet on that team and that concept. Other investments I've made when I know something about what they're doing, typically in the software, hosted services applications, and I've launched 4 of those companies. So different angel investors will have different investment criteria, and you need to understand as an entrepreneur whether you're in alignment with their objectives, number one, and you have to build a personal relationship with them and understand how they're going to help your business.
Yeah, great, thank you. Jody.
There was a lot that was covered here. I'm not sure where to start. It's interesting. So, Austin on the end, the way I like to describe VC is kind of a swing for the fences model. It's fair assessment, right? Banks are about slow and steady, right? Angel investing, it's kind of swing for the fences. Would you agree with that, Pat? A little bit?
Yeah, you're placing bets.
Yeah, for sure. Sure. Yeah. Private debt's interesting in that, the vast majority of companies, or at least in my experience, are still, they're not profitable. They have a trajectory, and generally speaking, you can kind of look, in the nature of debt, in the type of debt I execute, it's all backwards looking, right? We're looking at your operating history to inform how we think that business is going to perform going forward. And more often than not, if your business has not reached a point of profitability or at least sustainability, we're going to look at the trajectory of that business. We're going to use some kind of, assumptions based off that operating history to make a calculation as to whether or not we think this business can, one, service the debt that it's proposing to take, and two, not run out of money before we get paid back, right? VC, absolutely, probably the most expensive form of capital you can go get. And a lot of the entrepreneurs that I've worked with historically, they hadn't really realized that yet. So you have to be patient with them in that, I might have a conversation, and I would say of all the money that I've deployed, probably on average is probably around high teens, low 20% type interest, which is, that's not inexpensive, right? You need a really strong strategic case for why you would take money at that cost, right? But even at that cost, VC cost dwarfs that cost of capital, right? And sometimes I have to be very patient with entrepreneurs. They have to go out and get kicked around in the market a little bit before they come to that realization that, that 20% money that you were talking about actually is a pretty good deal, right? And and the other piece, debt is a little more forgiving around things like growth rate, right? So VC, and I think this is changing a little bit with VC, particularly kind of what's transpired over the last few years, the SVB collapse, some other market headwinds that have really showed up. For me, starting in 2010, I joined this little fledgling startup locally here called PitchBook, which most people have heard about at this point, right? And it was literally 15 of us in a little room in Pioneer Square. I had to like put my head under the desk when I was taking calls and cover my ears just so I could like hear what the other side was saying. That business did about $500,000 that year, right? That first year. Got bought by Morningstar, I think like 5 or 6 years later for like $225 million or something crazy like that. The reason I bring that up is that John Gabbert, the founder, told me about how he took about 200 meetings with potential investors. Not one VC saw the vision. Not one VC saw the vision. He somehow got it started with some friends and family money. He wound up taking a strategic investment from Morningstar. Now you see it everywhere, right? And so not everybody's going to see your vision, but going back to what I was saying before, like you're not going to see these hyper growth rates in most businesses. You know, it's like for a bank, they might expect to see like 5, 10, maybe 15% growth year over year. Yeah, that's good. In my world, you know, I'm like, hey, you're 20, 30, maybe 40. That's good. VC, they want to see you doubling up every year, right? It's a different animal, and you know, so it's basically go hard,
Jody,
or go home, right?
Don't sandbag growth rates like that, and we need more.
Right, exactly. And so that kind of goes back to my original statement about just understanding the nature of the money that you're proposing to take into your business, and is it truly aligned with what it is that you're capable of accomplishing or even want to try to accomplish, right?
I'll throw in here one distinction maybe between Pat and I from the angel investing and venture investing perspective that I think is important, because they can sound kind of similar, and I want to make one thing really crystal clear. We answer to different people, right? Pat answers to himself as an angel investor, right? I answer to a bunch of investors that I said, hey, I'm going to take this box of money and I'm going to make it way bigger in 10 years, or like you're going to fire me, right? And how that manifests, right, is if Pat does a med device company and I do the same med device company, and we do it early, and let's say we sell the company for $50 million, right, and we 4x our dollars. Pat's probably pretty excited with that outcome, depending on what he thought at the beginning.
I get my money back.
Yeah, but hey, Pat gets his money back. Hey, maybe he 2x's his money. He's like, that was great. I'm a failure. And so that is the difference between these two, right? Like, I don't care necessarily about that $50 million outcome. It's good, right? But that's not my goal. That's not my hurdle rate. And I answer to somebody else about that. Whereas Pat only answers to himself, so he can be slightly more flexible for how he thinks about some of these companies.
If I may add to that, from the difference between the expectations of an angel investor and the role of an angel investor versus your level of funding, when an angel investor invests in a company, they generally have the expectation that they're going to have a real major impact in that company. They believe in the product. They're really aligned, spiritually and strategically with the founder. And they believe, since they got in early, that they're going to, continue to have a major impact in that company until the next round of funding comes around. And there's a golden rule in funding, and this is the last money in makes the rules. And so, as an early stage angel investor, you better be prepared to have a conversation and understand with the management team that you're investing in what their long-term investment strategy is going to be and how that's likely to affect your initial investment. One key issue is, should the entrepreneur take equity for their seed money? Which I see people doing this, and it's like, why would you do that? It should be debt and convertible debt, so you can play along with the next round that comes in, not try to set the rules early on, too early, because those rules are going to be changed.
That last money in makes the rules applies for me too, right? Like, let's say it's Daniel or Jamie Dimon at JP Morgan throwing debt on top of one of my companies. They make the rules at that point, right? And if stuff doesn't go well, it's Daniel getting his money back out of the company, not necessarily me. And that goes all the way up the capital stack into what Jody does, into what I do, into what Daniel does. And I like that. I like that saying quite a lot.
interestingly enough, I mean, I've funded a fair amount of companies that took VC or angel money. And when debt comes in, we're senior, so we're actually always the first ones to get paid. It's like in a liquidation scenario, down, after in place. Yes, correct. Right. But in terms of the capital stack, we're the first ones to get taken care of in any scenario, whether it's a great outcome or it's a fire sale. We get the first seat at the bone.
Okay, I have lots of other questions for them, but I think we want to have some time for our audience to ask questions. So why don't we go ahead and open it up. Angie, who is our amazing event planner, award-winning this year, she has a mic and she will be walking around. So if you have a question for any one of our panel members, great, awesome. Go ahead and wait till you get the mic and then ask the mic so that everybody can hear.
Hello. Quick question. You guys, or a few of you, mentioned the importance of aligning your strategic values with those of your founders. How do you pivot or handle disagreements if your values don't align?
I mean, I can start. There's a lot of dating up front, as you can think about it for us on the venture side of things. And I think the one unique piece about it's maybe similar for everybody here, but both parties have to say yes to an investment from me. And the way things go wrong is like, hey, you didn't necessarily do the work up front to figure out who the other person was, and that goes both ways. I see venture capitalists making that mistake, and I see entrepreneurs making that mistake. If I see a founding team that isn't doing references on me before I invest in a company, that's an interesting signal to me about making this investment. As the company grows and changes, maintaining and strengthening that relationship over time is very important, not just between me and the entrepreneurs, but between the other people they're raising money from. And there's a lot of communication that should be happening in the background so that when the hard conversations happen, you can have a productive conversation and everybody is on the same page. Hopefully that answers the question.
I'll ask a quick follow-up on that too. Pat, you want to jump in? But what I was going to ask was how long does this process, you talked about this dating process, how long does this process typically take in terms of someone interacting with either an angel investor or a VC?
Sure. Well, I just follow up on what you commented on first. The reality for angel investors in an early stage company is there's typically several. It's not just one. And there's different types of angel investors. There's those that do their due diligence and make a decision and place their bets, and then they're off there building a portfolio. And they're really, betting on the odds. So the rule of thumb that as an angel investor, you shouldn't invest more than like 15 or 20% of your net worth in early stage companies. And secondly, you should build a portfolio of at least a dozen and then plan on reinvesting in at least half of those, perhaps, so you keep some powder dry. And for those, some investors want to participate on advisory boards and stay really connected with the company, with the founding team. Others don't. That's the last thing they want to do. They don't have time to do that for their portfolio. But for those that do, that's where it's important that you stay in alignment as far as values, and you do that by communicating with them and involving them in the organization in some way. So just a quick example, I have an investor in my current company who's a former patent attorney who's been on my advisory board and has helped us prosecute half a dozen patents, and he does it very inexpensively. He's very good, and he stays very much in touch with the company, so our values are just inherently aligned. And so I urge all early stage investors to look for those advisors, because the ones that are wanting to help you typically can't help you. And I'm sorry, what was?
Yeah, the follow-up question was kind of how long this time, what is the time frame for raising capital?
All over the board. Typically it's longer than you hope, longer than you expect, but it's really depends on how you go about engaging with companies. So for instance, with Career has a standard structure and format for deal screening, which you can be involved in, and then there's a due diligence for the ones that make through the first level of presentations. There's a due diligence process that as a member you can be involved in, and that's a rote process that takes a certain amount of time, generally months, not weeks. Other approaches, if you're not dealing with an angel network, you kind of have to be faster and you want to make quicker decisions, so you're going to do your own due diligence, whatever that looks like. Hopefully the entrepreneur has been wise enough to do one thing when they start their company, if they do nothing else, and that is to establish a due diligence locker repository and start stacking your due diligence materials from day one, because doing it retroactively is a real pain in the rear.
Austin, do you want to add that?
Yeah, I'll echo Pat's comment that it varies. I've seen companies get funded in less than an hour. I've seen companies take years, plural, to get funding from venture capitalists. That's the spectrum. Our process in Voyager is measured in weeks, not days, not months, right? Everybody has a different philosophy with that in my world. In my opinion, the best relationships that folks develop happen over the period of months and sometimes years prior to an investment, where, hey, I might have met somebody years ago, they were working on their last company. We maybe didn't invest, but Austin, and we just stay in touch throughout the months or years, and then the next time around we end up investing in that company for whatever reason. I think that's the best way these relationships happen, but it is very much a spectrum. And usually if you're raising money, I would expect that process to take, from venture capitalists, at least a quarter, if not a couple quarters. We give our companies the advice of, hey, if you're 6 months away from running out of cash, you're probably too late to be raising money by that point. You want to give yourself 6 to 9 months to get that process going. I think Daniel mentioned this point, right? If you need debt, you're not going to get it. Right. Oftentimes, if you need venture capital, you're not going to get it. It's best to be raising when you don't need the money.
I would, yes, absolutely, across the board. Timeline. If somebody comes into any respective lender's pipeline in the private lending space, I think realistically you're looking at about a 90 to 120 day process. That's like if you're actively looking to borrow and you're capable of borrowing. But I would say, like, from a relationship perspective, in my world, probably somewhere between 12 and 18 months from the point that you first engage to a point that a deal actually comes to happen. And so one of the things I do is advise lenders on how to kind of stand up their originations practice. And what I try to teach them is that, like, hey, the deals never happen on the 1.0 conversation. That's like very, very, very rare. It's usually the 1.2, 3, maybe 4 or 5 conversation. And so building the muscle of relationship building, understanding that you never know where any single interaction is going to lead, and making sure you're bringing your best version of yourself forward in those interactions. Because just to point out how small this ecosystem is, Voyager invested in Lighter, right? Incubated Lighter. I didn't even know this. Pat was instrumental in setting up N2H2. That was my first job in tech, was at N2H2. That's what Eileen Doran said. I didn't even know that. So like like this ecosystem is very, very small, and people do check in. And so how you conduct yourself when you're in the market, it doesn't take long to burn your reputation.
Yeah, there's nowhere to hide.
Yeah, Pat,
even nationally, like it's not a big ecosystem.
Can we do one more question? Okay, we can do. Auntie says we can do one more question, so we'll take one more from the audience. Perfect.
Hi. Out of curiosity, are you guys seeing a diversification in new businesses with all of the innovation that's happening in the 21st century, or is it plateauing a little bit?
Sorry, can you repeat the question?
Are you guys seeing a lot of diversifications in the companies that you guys are funding, and with all the innovation that's happening in the 21st century, or is it plateauing? With new companies, new
Like
businesses.
diversification of the industry or the product?
The products that the companies are selling and that you're investing in.
I think what we see is, and we fund technology companies, right? So I can only give you that perspective. We're in the middle of what seems to be the next big technology shift. If you think about how this has progressed, it's been personal computers to the internet to cloud and mobile, which enabled software as a service, and now we're going through, as I'm sure everybody's at least played around with, the AI revolution, whether that's the stuff that OpenAI is building or some of the adjacencies. We're seeing that proliferate into parts of the digital world. If you haven't used ChatGPT or the tools around that, I highly, highly recommend you do that. But we're also seeing this in like the physical world. So I have a company that uses AI to weed row crop fields with lasers, right? And that means you don't need to use herbicides to farm. And it turns out that your crops grow way better if you're not spraying poison on them. Who would have thought, right? And so some of that stuff I think is really interesting and underhyped when it comes to the way the AI can impact our world for better.
Yeah, I would comment on the AI arena as well. Our company, we've actually been doing AI for a dozen years, and what we do is we use AI to build predictive models based on data, historical data, to predict outcomes for business processes. And in our case, it's scoring or grading leads and their probability to convert to a sale, particularly in the insurance arena, health insurance arena. So I think there's a lot of diversification that's happening within existing enterprises, looking for ways to apply AI in new ways, in innovative ways. And I think you're going to see a number of companies be spun off to commercialize some of those technology solutions that existing companies find that worked within, that they developed internally, that then they see an opportunity to take that to market in some way. In general, I think the innovation arena in this country, like everything else right now, is in a state of flux because there's so much uncertainty about the future. I anticipate that the funders are going to be more circumspect in what types of deals they're investing in, because there's not a lot of evolution in some of these areas that are pointing to real investment opportunities. AI is kind of dominated by a few major players right now. They're getting all the attention and therefore all the funding. So I think it's going to be very interesting to see how this all plays out over the next couple of years, and how AI is going to then spawn new types of concepts in terms of products and services. And then I think you'll see more diversification.
Interestingly, from a debt perspective, like, I don't know, 5-6 years ago, it is blockchain, everything's blockchain, right? And in my world, it's like, hey, until it's been productized and like it evolved into like some sort of actual like legit operation, there's just nothing we can do with it. And interestingly, as much froth as there was around blockchain, maybe a handful of companies that I wound up funding that had some aspect of blockchain in it. And I think AI probably has more legs than blockchain in that context. But for me, it's like, okay, when does it actually start really like productizing and showing up, and it's not all centralized with like a few players that are just taking in gobs and gobs and gobs and gobs of money. That's kind of how I look at it.
Yeah, I think it was parallels between blockchain, and it's interesting to bring that up, because I looked at a lot of blockchain companies, and even though I have 30 years in tech, I didn't really understand blockchain. And I dug a lot into it very deep, and actually been involved with a couple of blockchain companies, but it was kind of a passing fad because it didn't have that consumer focus as the way that AI does. Because now AI is can be put in every consumer's hands to a certain point if you just go, and try it, and you all should, I concur. But I think that will result in a lot more creativity and concepts coming from unexpected places. As where blockchain is kind of like an operating system that nobody ever really understood.
I think, well, this is my hot take, and I'll leave you with this. Blockchain is good for currency speculation. That's not a whole lot else. But like I disagree with the macro environment maybe doesn't look so good. Like venture capitalists aren't going to fund anything. I think that's false, right? The best people in my world don't really care what the macro is doing today. We just keep doing the same thing over and over and over and try to capture some of these up and down cycles, because the only thing I know about my outcomes is that they're going to happen 10 years from now, and I have no idea what that's going to be. I just know it's not going to be right now, so the only thing I can do is keep investing in innovative companies. And hey, we'll see where we are in 10 years, right?
All right, great. That's a great place for us to end. So let's give our panel a big round of applause. We have gifts for you all to say thank you. Awesome. All right. Thank you. Thank you, thank you. Thank you. Here, hold on. Good job. Okay, thanks, Jody, for the hand up. Okay, thanks, everybody, for coming. And one last Go Cougs.
Go Cougs. All right. We also have a gift for you, Marie. Thank you so much. You did a great job. Just some housekeeping notes. Next door at 2 p.m., you'll get to hear from Dr. Cantwell, the new president of Washington State University. If you haven't gotten your badge printed out, you can do that on the first floor, and the show floor opens at 3 p.m. Have fun, network, and a final, Go Cougs!